Welcome, everybody, to the Q2 Jacksonville real estate market update. As we said earlier, I'm Pablo Gonzalez. With me, as always, the guy with the genius concepts, the guy that knows how to generate cash flow, the guy who's a great co-host, the guy we call Gregg Cohen. GC, say hello.
Hello, everybody. Great to be with you.
And, we know that this is our most attended show, right? Because when people say Q2 Jacksonville update, you get a bunch of folks that show up and they say, I know how special the Jacksonville market is. I'm looking into it. So this often comes up in a search result. Mm-hmm. Or there are people looking at JWB. They know that you're the category king of real estate investing and vertical integration. And here in Jacksonville, one of the best known companies on the front page of the Wall Street Journal a couple of times. They want to know how your brain works. Or you are one of the 2,000 plus investors that trust JWB with your money, like myself. You want to know the guy that is holding on to your money, how smart they are. So you come here for the first time because we do a big push. And what we want to tell you is that we do this thing every Tuesday and Thursday, and we try to make it as easy for you to be a part of it as possible. If you want to really understand how to think for yourself and not just take average investing advice, then you can listen to us on the podcast. Just look for Not Your Average Investor Show. You can go to YouTube and look for Not Your Average Investor Show, or you can join us live on Tuesdays and Thursdays if you want to get close to the center of the sun, be a part of the community, ask questions, and you also get to be part of a little tradition that we have around here. GC, do you know what that is?
It's called the roll call, baby.
The roll call, where we call out our community members like Denny Davis, who is saying Guten Tag from Germany. Hello, fellow investors. We got the ringmaster of the Not Your Average Investor community,
Andrew Barnhill.
We got the leadoff hitter, batting third today,
John Henning.
We got the MVP,
Lee Bishop.
We got the fiduciary financial advisor,
planner extraordinaire, Kelly
Barenbaum. We've got the surfing champion, most interesting man in the world from Hawaii.
It's none other than Zach Correa.
Aloha, Zach Correa. We got Layla Powell in the house. Layla, good to have you. We got Walt Hart in the house from Middleburg, Florida. Good to have you as well. We got Mari Leitner. I think that's a new name.
New name. All right, Maury, welcome to the party.
We have a lot of new names. We're welcoming you to the community from LA. Who else we got? We got Chris Locks in the house. Will this recording be shared with attendees afterwards? Absolutely, Chris. This is right now live on YouTube. On Monday, we release it on podcast and post-produced for the YouTube audience as well. We have our community manager joining us right now, Madison. She's going to be in the chat helping you if you got any questions. We got Tara Klein, part of the team over here.
It's the mother of the flywheel.
The mother of flywheels.
The mother of flywheels.
The mother of flywheels. We talk about her often. We got Nadeem Shah with his trademark good morning, good afternoon from the West Coast. We got the second family of the Not Your Average Investor Show, the regulars, Rosalind and Gary Riley from Marietta, California.
We have not done a proper salute to them before. Let's nail it on the quarterly call. We salute you.
We got our favorite name to pronounce, Aaron O'Neill. Into that right, Aaron O'Neill. We got Big Papa in the house. We love it when he calls in Big Papa. Love it when he calls in Jay Cohen, Greg's dad, who's a regular on the show. We got Laura Colby back in the house from Washington State. Good to have you. We got the man from Hotlanta,
Eddie Harris
checking in. We got past star Misty Johnson out of Colorado coming in. We got the maven of real estate from Denver, Colorado.
None other than Miss Leslie Wilson.
Leslie Wilson. Kelly is the fiduciary flat fee advisor. Ooh, yes, we got to keep adding ups to it. I love it. All right, we got some folks checking in. If you checked in from a text reminder, you populate as Not Your Average Guest. So you can go in and change your name so we know who we're talking to. And we got somebody from Layton, Utah.
All right. Love Layton, Utah.
Do you? Have you been there?
No.
I heard Utah's a beautiful place. Gerard Wendling in the house back from Central Indiana. Good to have you. Janer Nava in the house from New Jersey. That's a new name. Welcome to the show.
It's a new name, but I think it's Diana from New Jersey.
Oh, okay.
A little confusing there.
Oh, Diana.
We welcome Janer and Diana. Right. However you're here, we love that you're here.
Thank you, Diana. We got Alicia Heimbacher. Happy Tuesday from Pennsylvania. Alicia, good to have you in the house. We got Joe B1 Kenobi.
Joe Bussy
in the house. If you're catching a constant here is that if you show up enough, you get a nickname.
Mm-hmm.
And we like to take it real seriously. We got Pedro Nacianciano from Jersey. Good to have you back, Pedro. All right, let's kick this off. We got Victor Mudrick saying hello. Good to have you, Victor.
Long-time client.
Robert Jones with a howdy. Tanner Charles.
JWB team in the house.
Tanner is a teammate. Katrina G'day from the First Family, second daughter, the Duchess.
Another Duchess. We're so happy to have the Duchess.
We got Milady Jag Chata in the house from New Jersey. Alex Diaz, Alejandro Diaz, Alex and Alejandro Diaz. So Two Alexes.
There we go.
From Virginia. Good to have you. All right, GC. We're always highly attended here, right? Because we've grown this tradition that quarterly people show up to understand your perspective in the market. We like to talk about this idea that data plus perspective is what creates great decisions. From your perspective right now, what is the current state of the market? What are you hearing? Where have we been up until now?
Well, I think we've been in a steady state of concern as an investor in this country. I think we've been in a steady state of concern and alert and reactivity for a year now, right? Ever since the Fed started to raise interest rates at an unprecedented rate, 4.5%, 5% of rate increases is a lot. And what you see is in all aspects of this economy and whatever you're investing in, everybody is on hyper alert. And that's a tough place to be as an investor.
Mm-hmm.
As an investor, I'm sure you all are this way. I like peace of mind. Yeah. I like not having to check the stock ticker, right? I like not having to know everything about what Jerome Powell and the Fed are thinking as far as a potential rate increase. I like not having to know all of the job reporting data to see, is that a good thing that jobs are being added? Is that a bad thing that jobs are being added? So I think just from a pulse overall, we're in the steady state still as investors in this economy of not knowing what is good news, not knowing what is bad news. And it's a difficult spot for people to have data and perspective and then make good decisions.
Yes, I like how you said it, this reactive state. It's really hard to make great decisions when you are in a nervous state, when you are in a fear state, when you are in this state of overwhelm, right? Like we have a lot of news. Mm-hmm. There's a lot of noise in the ecosystem. It feels like most of it has been scary noise, right? Like the headlines have up until now recently been all about this doom and gloom. We're going back into another housing crisis. House prices are dropping. But here on the show, you've kind of been giving a different message. You want to kind of tell people about that perspective?
Yeah, I just told people that the reason that you invested in real estate is because it has been consistent. It has been consistent since, for decades, of course, and consistent through things such as an eviction and foreclosure moratorium. It's been consistent through the pandemic. It's been consistent. So it's not a surprise that real estate is still performing consistently. But that's a different message than what people are hearing and reading, right? I read those news articles too, and I read the headlines, and I feel bad for people out there because it's not accurate. It's not actually based on data, or the data that they're using lacks perspective. And ultimately it leads people to different and incorrect conclusions, because the reality is that real estate has been performing normally. Over the last year, real estate has been performing normally here in Jacksonville and in the majority of the country. But you would be led to believe that it's been on the verge of a crash for the last year. And so that's why I love this opportunity to sit here with all of you and just go through the data. That's what this Jacksonville real estate market update is, because I think it gives clarity. I can add my experience and the fact that I manage over $800 million of real estate portfolios here in Jacksonville to give you that perspective of what this is. And the great thing for all of you, and we have many of our current clients on the call right now, you are being rewarded for being in such a risk mitigated, consistent asset class that has potential for upside. And you just don't find risk mitigation with an upside potential in many assets right now. So I think you all should be feeling really good as we go through some of the information here today. And for those who are continuing to build their portfolio and adding assets, I think you're going to see a different perspective than probably what you read out there. It's one of consistency, upside, and a real reason and urgency to continue to invest in this asset class.
Okay, cool, man. So I think it's time we bring up some data, right? Like I think we've talked a lot about the perspective piece. Let's go to one of our favorite charts that we like to talk about, right? We often talk about this idea that when it comes to real estate, you want to look at it from a full market cycle in order to have the right perspective.
Mhm.
So we often go to this chart here that we share, and we update it every single quarter, that shows the historical home price appreciation in Jacksonville starting in September 2002, I guess, maybe a little bit before that.
Mhm.
And it shows this mean of a red line that shows it at is this the 4.6% line?
Yep, exactly.
Right, a 4.6% appreciation, and then a blue line that likes to take these little blips up and down, all while following this general trend. You see in the Great Recession years, this moment where it goes well above the mean and then comes way back down and then starts crawling back up. And then at some point here in somewhere around 2021, 2022, something like that, looks like it crossed back over and it's continuing to do its like up and down thing, moving upwards. GC, what do you want to tell us about this line before we go into the specific time that we are in right now?
Well, this just reinforces what we believe. Those who own real estate for a full market cycle or longer, a full market cycle is between 10 to 20 years. You know that real estate is cyclical. And so when you see that trend line, that red line there, that's the expectation of what home prices should be performing at. What you see is the cyclical nature of home prices. Sometimes they go above the line. Sometimes they come below the line. Sometimes they go right back above the line. Sometimes they come below the line, but it starts to progress upwards on that line. And that line is a little bit better than the average rate of inflation over time. So when we talk about a hedge against inflation, things tend to go up with inflation, and it's consistent, right? You don't see huge swings in volatility. Even the Great Recession that we looked at right here, I know that was a big swing in prices in real estate, but you compare that to other asset classes, and that's a blip on the radar when you compare it to swings in the stock market or other things. So, when you look at big picture of this graph, the cyclical nature should become apparent to you, and that over time, things tend to go up, which is what we see in home prices. As you hold on for a full market cycle, they tend to go up about that same rate that they performed at over most recent market cycles, which in Jacksonville happens to be about 4.5% appreciation per year.
Got it. So let's go into recent history then, GC, right? Like we obviously went from a long time under this mean line and trending upwards to all of a sudden we crossed it in this like gigantic appreciation that we had in the last 2 years or so. And then, over here, we start to see a little bit of a dip again for the first time. Can you tell us what this thing means?
Well, let's call it. Was it a little dip in the minds of the media? What was going on for the past year?
Yeah,
right.
This dip here is where these last 6 months of like headlines of like doom and gloom and a recession.
And
coming.
even before that, let's go back to this foreclosure moratorium that we were under. How many of you all read headlines about the next crash that was going to happen because of foreclosures that were going to overrun the real estate market and lead to significant price declines and crashes? Right. There are a lot of talking heads out there for even longer than 6 months, longer than a year, have been predicting this next housing crash, and it just hasn't happened. So the last 6 months, the last 6 to 9 months have been more and more loud and strong noise in this pending real estate crash. And you know what? This is a really great opportunity to lean into the data here. And this is what we show this graph every single quarter. So you, and those who attend every single quarter, you see the same chart. And it's comparing apples to apples. But let's look at what's going on here. Let's get inside the minds of the media and those who say that the crash is coming, because you see that decline happen.
Yep.
Right? And if all you did was just look at the data month over month over month, in real estate, you might conclude that we were on the path to a crash. But if you don't have perspective, you would be down the path of the wrong conclusion.
Yeah.
Because as we look farther back, and we're going all the way back to 2001, similar rates of decline happen every single year, right? From June to January, every single year, home prices decline month over month, almost without exception. The only time it didn't happen was the last couple of years when the real estate market was not normal and home prices went through the roof.
Yeah, and that's that giant line here that went way up above the red line.
Yeah. So you're mixing like a whole bunch of things together here, right? The media, everybody has been waiting to predict the next real estate market crash. The reality is that doesn't happen very often, but it sells clicks and newspapers if people still buy them. Yeah. So they've been waiting for it. And now they're starting to see home prices decline month over month for the first time in 2 years. And people who don't have perspective say, oh, geez, that's going to lead to the next market crash. We're already in the crash. It's happening. When in reality, every June to every January, you see month over month declines. And why does that happen? It's because there's less demand.
Mhm.
It's because, as you get into the fall and the winter months, it's snowing outside in a lot of the country, right? Everybody's worried about the holidays.
Mhm.
People are traveling, right? People are distracted. They're not out looking to make a purchase for a home at the same rate in the second half of the year. From June to January, on average, home prices decline over 8%. And that data goes all the way back over the last 20 years. So you've heard a lot about home prices that are declining month over month. My answer to that is, yeah, no duh. That happens every year. It's weird if that doesn't happen.
Got it. So then I know that we talk about this a lot on the show, but I know we have a lot of new audience today because we always do on this quarterly report. Does that mean that if I'm going to invest in real estate, then I should invest in real estate sometime between like November to December during this like big drop kind of thing?
So, if you're going to buy a house for yourself to live in, I think it's a really cool takeaway. And that's why this show is great for those who are investing, but even for those who might not be investing. If you've got your owner occupant hat on and you want to see where you want to live, yeah, take this information and go and try to buy the house that you want to live in personally in December, right? You're probably going to have a chance to get a little bit more of a deal on a property that you're buying. As an investor, as a passive investor, which is the majority of our audience, those who want to buy single family rental properties from a vertically integrated provider like JWB, it's not the same opportunity. JWB's inventory does not have seasonality to it. And the biggest reason for that is that we're not a motivated seller because the assets that we have are rented, right? They're rented by us before we sell them to you. So they're paying for themselves. There's not a huge, motivating factor. Whereas in the typical retail market, if you're an owner occupant, you may find that opportunity. So a little bit of a difference here. If you're investing as a turnkey investor for passive income, probably not something, don't wait till December to try to find a deal. But if you're going to be buying a house for yourself to live in, sure, take that information and run with it.
Yeah. So those of you that are checking in as active investors, as people moving to Jacksonville, you'll find better deals November, December, as if you are actively looking for yourself. If you are looking for the state of the asset class in the turnkey range, you know that this thing is just going to be a consistent thing. And especially if you're buying from a turnkey provider that is super, super stable. And we'll talk to you about how you become stable as a turnkey provider, right? So GC, let's talk about the tail end of this thing, right? So I looked at this for a while and I'm like, wait a minute, is this thing really crashing? And then I just realized it's kind of an optical illusion. The whole idea that it went up so much and then it kind of comes back down has happened many, many times after I looked at it really, really closely. But the other thing that I'm seeing is this little lip right here.
Yeah.
That seems to
what's going on? What's going on over there, Pablo?
It looks like we are entering that phase where the seasonality says it's time for it to go up, right?
6 months ago, 9 months ago, I was sharing with you all that you are going to read negative headlines that are going to be calling for this real estate crash for the last, the end of 2022. And there was no shortage of those, right? Yeah. We all were inundated with those. But, a few months ago, I was like, what's going to happen on the other side of this is that you're going to start to see headlines talking about how home prices are rising.
Yeah.
They're going up. So guess what? I just pulled some headlines from the last, week or two. CNBC says home prices suddenly jump after several months of declines. Market Watch, U.S. home prices rise for the first time in 8 months. Remember that 8-month number.
Yeah.
How many months between June to January? I don't know. Somebody let me know in the chat, right? Bloomberg, home prices are rising even in one of the worst hit U.S. markets from May 8th. And then Yahoo Finance, home prices rose more than previously thought in the first 3 months of 2023. How much do you think they previously thought it was going to rise?
I don't know. Maybe they thought it was just going to continue to tank. I don't know.
So what's going on here? So this is an opportunity for me to hold the standard with you all, no matter if it's really good news coming out of the media or if it's really, nonsensical negative news coming out of the media. Guys, this is seasonality, right? So as I mentioned to you, housing prices almost always drop from June to January, but guess what they do from January to the next June?
Go up.
They go up.
Yeah.
They go up. This is normal seasonality. Just as JWB has been predicting, this real estate market is performing normally. So this should give you even more confidence that this is not the real estate crash of 2008. It is not going to be similar to that. This is going to perform like a normal market.
Got it. So if we get this perspective along with the data, right? Like these headlines are data without perspective, right? They're living in the moment. They're like, oh my God, 8 months and now this is happening. They're not looking at this thing as a full cycle. They're not looking at year over year comparisons, right? They're just looking at month over month. The right way to look at this thing is how it's performing year over year.
Right.
And we talk about that often on the show, but let's talk about what the statistics are. Those are all things that you can predict and you've seen, but what you are saying now is that there isn't going to be a real estate market crash. That is something where you are future facing. You're looking at data, you're adding perspective. Let's talk about the data that you're using for that.
Okay. So how do I know it's not going to be a crash going forward?
Yeah. What are you basing these statements on?
So I look, there's two major influences on the real estate market, right?
Mm-hmm.
There's supply and demand, right? So there's the supply of housing.
Mm-hmm.
Do we have enough to support our demand? And then there's demand, which a lot of that rolls into home price affordability. And a lot of that is driven by interest rates and, can you afford the mortgage payment? So it's a little bit more than just the home prices that roll into that. But it comes down to two things. It's supply and demand. So everybody's really talking about the demand side, which is affordability, which I get you, right? Things are less affordable today than what they were in the past, right? They're talking about the Fed's increases, which is substantial. We do need to pay attention to that, but that affects affordability, which affects demand. Not many people are talking about the supply side, but the supply side is just as important. If there's no houses for people to buy or a very small number of them, then people who are moving to a growing population like Jacksonville are going to pay more for those houses.
Yep.
So we got to focus on the supply side as well as the demand side. And that's really where I want to take our conversation right now, because when we start to think about why I know this is going to be a normal performing market and not a crash, I don't have to look any farther than supply. But let me bring you up to speed with an easy way to understand, do we have enough supply to support our demand? It's this wonderful metric called months of inventory. Call it MOI. We talk about it often on the show.
I remember the first time it made an appearance on the show. It was March 2020.
That's right. That's right.
When all the headlines were saying that we are about to crash, everybody was freaking out. And you said, in the short term, it's definitely not. Because MOI.
How much of this message that we're sharing today has been a consistent message where everybody said, hey, listen, this is going to be a crash in March of 2020. I went to the supply side of the data.
Yeah.
And I said, what is months of inventory telling me? And after that, that's why we were able to come strong when the rest of the world said that real estate was going to crash in March of 2020. We, in our group here, said that's not going to happen. We said home prices are not going to go down. And it's because of this information that I share with you all. So if this is your first time hearing it, I hope you pay attention, because it should give you more perspective and you'll be much more educated than those talking heads out there who are writing crazy headlines.
So if you're on the podcast, listen, we have this slide up that says months of inventory, right? And we talk about this idea that months of inventory will tell you whether you are at above average or below average home price appreciation on the show all the time. The average home price appreciation for Jacksonville over a full market cycle is 4.6%. And the average months of inventory is somewhere between 6 and 7. So basically the takeaway is that if you are below 6 months of inventory, then you can expect a higher than average home price appreciation, higher than 4.6% a year. And if you're above 7 months of inventory, then you can expect a lower than 4.6% appreciation rate. Now that means that above 7, you start getting into 4% appreciation rate, 3% appreciation rate, right? Like there can still be positive appreciation above 7 months of inventory. It's just going to be less than 4.6%.
Well said.
Right?
Well said.
Okay, cool. I just wanted to get that clearly out there.
Yeah, it's like any other business. Think of yourself, right? If you have widgets to sell, if you have low inventory and you have a ton of buyers out there, there's going to be upward pressure on pricing. And the opposite is true. If you have a ton of inventory and you don't have very many people that are buying buying inventory over the last month, well, there's going to be pressure to decrease your prices. So this is a metric that, and we'll start to look at some correlations between how housing prices have performed and what this metric has done in the past. But it is a really important indicator. And it's one that my team, we buy millions of dollars of real estate every single year. It's one that we know every single month because it's that important.
Cool. Let's look at the correlations.
So let's give a little bit of data and perspective here. So I'm going back 2 years now, and I'm looking at the Jacksonville real estate market, and I'm looking at the number of houses on the market, which is your inventory. And then I'm looking at the total sales on the market. And then that calculating our months of inventory. So we had about 3,700 houses on the market in March of 2021, and we had 3,400 sales in March of 2021 for months of inventory of 1.1. Guys, 1.1 months of inventory is incredibly low. As an investor in Jacksonville, I own over 300 rental properties. I've owned them since 2006. I have never seen months of inventory that low. That has been the biggest reason why home prices went so high over the last 2 years. It's the supply side of this.
Yeah. And so high means we've had like 12% home price appreciation, right? Like what?
Yeah, 15 to 20% appreciation
20%.
2 years in a row.
Yeah, 2 years in a row.
So that is incredibly low. To give some perspective, I've seen it where houses on the market has been over 16,000 houses on the market at one point. So to have almost just 1 month of inventory for the number of sales is incredibly low. And that's why 2 years ago, all of us on the show, I was openly talking about how prices are going up. Yeah. And this is the time that you should be investing because home prices are going to go up. So fast forward to March 2022, houses on the market are down a year ago, 3,200. We're not solving that supply issue, and that's increasing home prices. We had 1 month of inventory. Again, unbelievable. I'd never seen it before. And we still have a tremendous amount of home sales because people are moving to Jacksonville. It's interesting. Home prices had gone up 15 or 20% from 2021 to 2022, and we still had 3,400 sales in March of 2022. Yep. At the new high prices.
And if I was to look at this without perspective, I could have said year over year, sales went down.
Yeah, right.
Right.
It's a really good perspective there. That's not, yes, that is accurate, but that lacks perspective. We had never been over 3,000 sales in a single month in Jacksonville history before June of 2020.
Yeah.
Never happened.
Yeah. So let's talk about now, man.
So now we see, and then let's put ourselves again in the mindset of those who may be looking at this and concluding incorrectly, okay? You see houses on the market, and now it's 6,475. And you may say to yourself, oh my goodness, we're oversupplied. We have twice as many houses on the market now as we did a year ago. There must be way too much supply. But they don't understand that you need to look at houses on the market, and you also need to look at sales, the demand side of this. We still had over 3,000 homes sold in March of 2023. Our months of inventory is only 2.1 months of inventory. Guys, I was working with clients from 2013 to 2019. Right? I've been working with clients for a lot longer than that, but from 2013 to 2019, we didn't have below 3 months of inventory on the market. Like, this is unprecedented to only have 2 months of inventory. And that is the biggest reason to answer your question about why am I really confident that this is not going to be the crash, and why have I been saying this for well over 6 months now, as all these other talking heads have been saying it. It's because of the supply side, right? We are undersupplied as a market here in Jacksonville, and that leads to price stability in the short run. While we don't know what the Fed is doing with interest rates, at the very least, it's leading to price stability in the short run. And you're going to see this is the foundation for above average and upward pressure on housing prices, especially over the next 3 years. It's because it takes time to build that many houses to solve the supply problem.
Got it. So what you are saying is based on this MOI number, based on this historically low supply in comparison to demand, you see prices being stable beyond what's going on with interest rates and what's going on with pricing and the different kind of like headlines that people are putting out there.
Yeah, I see there's an incredibly high floor for pricing. And I don't know if home prices are going to go down a little bit or go up a little bit for this year. You know, honestly, I don't think it matters if you have a buy and hold mentality, which you're in this because you want to buy and hold because you benefit from all 5 profit centers. Does it really matter if home prices go down 1% this year or 2% this year and then go up 5% next year and 3%? No, right? What I'm really convinced of is 3 years from now, home prices are going to be higher than what they are today. And much longer than that, I know they're going to be higher as well, right? Because again, if we go back to the cyclicality of home prices on that first slide, home prices over a full market cycle tend to go up about 4.5% over a 10 to 20 year cycle, right? 4.5% a year. That's what's going to happen here.
Got it. And to give a little bit more perspective on MOI and home price appreciation, we talked about this idea that it's below 6, it's going to go up above average, above 7, then it starts to increase, just not as much until a certain point, maybe can go down if it gets a certain high. So just want to give some more perspective with data here of historical MOI and home price appreciation. In December 2007, right before the crash, it was at 18 and it dropped for 10% for the next
that's when we had 16,000 houses on the market and only 900 sales. So if you're listening and you're saying, well, when would Gregg ever really say that home prices are going to crash or that home prices are going to decline? If I saw 18 MOI, I'd be talking to you guys about, hey, there's going to be some pain in the real estate market, right? Because I've lived through that. I owned those rental properties during that time. And you start to see that correlation. Same thing in June of 2009, we had 11 MOI, right? Home prices over the next 12 months in Jacksonville dropped about 10% as well. You know, so now from 2014, 2016, it started to change, right? We had MOI of 4.9 in 2014. And what do you know? Over the next 12 months, we earned 7.3% home price appreciation in Jacksonville. In 2016, it was dropped. 3.9 was the months of inventory. And you could see home prices 8.4. So the big thing here is, you know, there's clear cause and effect here, right? There's a causation here, and it should make sense. It's supply and it's demand, right?
Yep.
You don't have enough supply to support the demand. I do want to caution everybody as we're starting to get very specific about these examples. MOI is a really important indicator. It's not the only indicator though. So I don't want one of the takeaways from this call for you all to say, well, Gregg, if MOI comes up to 7, does that mean that home prices are going to decline? Or if MOI is 8, does that mean home prices are going to decline? This is too important of stuff to if it was that easy just to talk about home prices, just one metric, then, you know, this would be a much easier asset class to, you know, everybody would know what was going on, right? You can't look at this in a vacuum. So this is important, but it's not the only metric. You do have to work with a team to understand other metrics as well. But for our, you know, intention right now, what more causation do you need to see other than MOI and what home prices have done over the next year to at least conclude that when you have only 2 months of inventory like we have right now, that you have a really high floor? And that's really where I see it.
I like that verbiage, right? The idea that it's a high floor, right? Because it's impossible to take all the weirdness in the world right now and say,
Right.
Hey, this one statistic, this one thing is going to dictate whether I'm going to do well or not.
Right.
You know, or if things are up and down, right? Like nothing is as simplistic in this world that has become so hyper connected. There can be so many like runs on things and, you know, butterfly effects or whatever.
Right.
But at the same time, this MOI number gives you a very, very high floor, and you can't look at this real estate investment in a vacuum, right? Like I think we can look at all these different things. We have this high floor for MOI. I wonder if any other asset class can point to a single indicator and be like, no, we're good here. Like I don't think that there is anything like that out there in my purview.
Well, I would say that there's some indicators, if I'm looking at the stock market, that make me scared,
Yeah.
right?
Yeah.
The PE ratio, the price to earnings ratio, it's way higher than what historically has been, has been showing potential growth in the stock market. So things are overvalued still in the stock market, right? So that would be an indicator, and I'm sure that there's other indicators and other asset classes that have a high influence. But, I think against the backdrop of all of the media and all of the talking heads talking about how this real estate crash is happening, to have such a strong indicator that that's not going to happen is unique, right?
Yeah.
You don't typically see that in other asset classes.
Yeah, that makes sense. And Zach Correa is saying, despite the slowdown, Jacksonville's typical home values have seen an increase of 7.8% over the last year, which indicates that the market still offers some potential for growth. That definitely backs up what you're saying. Pedro Nascenseno saying he read some time ago that the local Jax government is trying to do something about home shortages. Are they having success, and will it impact MOI? What do you think about that?
Yes, there is a lot of movement. The way to significantly help home price affordability is to make it easier to build, right? To remove the restrictions to allow more density to happen, because that creates more supply.
Mm-hmm.
And so if you can increase the density and decrease the cost to building homes, that will have a major influence on home price affordability. So that's one way to solve it. And there's a lot of movement. In fact, there's some legislation that was just passed that will really, I think, help this. So I'll write this down for a future show, and we'll do a little bit more of a deep dive on that. So that's really positive. And then on the other side, the way to solve home price affordability is raising median incomes.
Mm-hmm.
And there's a tremendous amount that is being done in downtown Jacksonville specifically to bring in more employers, to build up downtown. And the end goal there is to raise median income so that home prices become more affordable because of that reason too.
Cool. So that's your outlook on the market, right? That's data plus perspective. I think there's other things that people come to this call are for what Robert Jones is asking in the Q&A, right? Like, cool that you're going to tell me this opinion. Now tell me what you're doing with your money and what's JWB doing, right? So in this call, we talk about the market, and then we also give an update on JWB's performance KPIs. They're key performing indicators. So Robert is asking how many houses did JWB build last year and what number is projected for this year. Robert, we got that for you right now. GC, you want to give us kind of like a high level view of what JWB is thinking and doing right now?
Yeah, absolutely. We are running our business like I am sharing with you as far as what we think the real estate business or the real estate market is doing. Mm-hmm. We're operating normally. I feel like the rest of the world expects people to be pivoting and making big changes. No, right? This asset class is built to perform across multiple market cycles. So when we shared in the beginning of the year, I rolled out our JWB business plan. And I think one of the questions you said was, it's really unique that you're not doing major pivots. Well, there's no major pivots that are required when you build a business that's based on a consistent asset. Yeah. And that's what we have here. So there are not major shifts and major pivots that are happening within JWB's walls. We're continuing to buy, we're continuing to build, we renovate, and we sell and perform the property management services. I will say though, that we are really growing our property management services as well. So of course, we manage properties for those who buy properties from us, but many are not aware that we also offer those services to those who don't buy from us. About 25% of the homes we manage are from those clients that didn't buy from us. So we're continuing to grow that because that continues to add strength and stability to our core as a business. And so, two things that we've done that would kind of be in that same vein is we bought 2 property management companies in the first quarter as well. So that's
and this idea of stability kind of flies in the face of what you're hearing a lot in other, the other local big real estate players. It's not what you're hearing from them. Roger Evans is even putting in the chat. I recently read that the Jacksonville market, along with a few other cities, are currently not lucrative for investors that are flipping homes as they're struggling to make a profit. They, however, indicated this is not true for passive investors that were buying and holding, right? So I think in a lot of the things that we talk a lot about on the show of stability comes with the thing that I like to talk most about the show, which is just JWB's strategy and the genius of its business model and how well you guys plan and strategize and execute for this long-term stability. Everything from how you're how your inventory is something that you can hold on to because it produces profit for you,
Right.
as well as your growth of the property management arm. I literally yesterday, Cody Sanchez, who I really enjoy,
Right.
put out this thing of like the best business to get into in 2023, and it was property management.
Really? Yeah.
Yeah. I gotta send that to you.
Yeah, that's cool.
Because it was actually interviewing the guy that I met at that Holdco conference.
Yeah.
That I was giving advice to based on what you do, that then reached out to me afterwards.
That's
So
really
this
interesting.
guy, Peter Lemon. Yeah, it was really, really cool. All right. So let's talk about the KPIs. Let's talk about the actual data here. The company update through April 2023, you've purchased 34 properties. You've completed 66 new constructions. You've completed 46 renovations, and you've sold 151 homes to investors. I think the number that really jumps out at me here is 1 quarter in, halfway through, through April 2023, 151 property sales flies in the face of the headlines of the last 6 months.
I know, right?
Yeah.
I know. People would be shocked,
Yeah. Yeah.
But when you can clearly articulate that this asset class can perform consistently in a world of other assets that are not consistent and highly variable and don't have good leading indicators, people rush to value, right? And they also rush to a great experience. And that's what we've always focused on. So yeah, those property sales numbers, I think, would surprise some folks. I also did want to address the question from our friend who asked how many homes we built last year and how many are we building this year. We built, I don't have the number right off the top of my head. I want to say low 300s last year is the number of homes that we completed for new construction homes. And the projection this year is about 390. And so we'll be somewhere right around there this year. So yes, continuing reinforcing that our belief in this real estate market here, and I think that building is going to continue because again, we see that the market is undersupplied and we have the assets, we have the land, we have over 3,000 lots that we own here in Jacksonville that we will continue to build out as demand is there for you, for our clients, and those will turn into turnkey rental properties for you all down the line.
There you go. All right, cool. Let's look at the KPIs for property management. Again, this is the consistent recurring revenue side of the portfolio. Rent collection percentage, basically 99%, 98.8%. Average rent per property of 1,389, and current properties under management of 5,190. Kind of all these numbers really pop out at me here, Greg. The first thing that I think of is average rent per property of 1,389. I feel like that was less than $1,000 yesterday.
Well, let me help you with that. It wasn't less than $1,000 anytime recently, but it has gone up significantly. The last time it was, lower 1,300s, right? And before that, as we've done this now for, 3 years now, you've definitely seen it in the 1,100s and 1,200s. Yeah. So you're right. And that number continues to go up. But man, I am just so proud of my team, right? To deliver 99% rents, right? Again, this is the backbone of consistency. That's why this asset class performs consistently. It's not easy today to be able to collect rents, right? The affordability issue is there, but there's also enough demand for our products and services on the property management side that my team can excel, right? 99% rent collection is world-class, right? Typical property managers, if they're decent, they'll collect somewhere around 93 to 95% of rents. And a lot of them have a standard of 90% of rent collection. So to be performing in an environment where affordability is an issue on the table represents an incredible job done by the 100 or so folks here at JWB. And I'm so proud. It allows me to come up here and to confidently give advice on where I think you should be placing your money. It's because of this stat right here, along with a number of other ones we're going to take a look at here.
Yeah. And I think honestly, man, the one that I'm most impressed with is this almost 5,200 current properties under management. I remember you telling me, this idea, again, we talked about that the other big residential real estate players in town have gone through some really, really tough times recently. You guys, 6 years ago, set out to build a property management company and set a goal to reach 5,000 properties under management because you knew that this was the recession buster, right? This is the recurring revenue that will keep everything constant, even if sales happen to go up and down for a short period of time. And the idea that over 6 years, you can hit this massive goal of 5,200 properties, I think is incredible just on an execution level.
I'm really proud of that number.
Yeah.
I'm really proud of this. This number means a lot to my team. We've rallied around this number for years and years and years. If you've ever had a goal with a group of like-minded folks and you wanted to rally towards something and it took years and years to get there, when we set this goal to get to 5,000 properties, we managed about 1,600 properties. And we knew that when we got to this goal, this would represent stability for the internal office here, right? Increased stability. Every time we take on another property management client, it increases the stability of our organization. And the reason that that's so important is because the team is the reason that you all choose to invest with us. It should be, right? The experience that you all are seeking when it comes to investing in real estate is the reason that you choose JWB over the alternatives. And the best way that we can support that is by having a team that is stable, that is happy in the face of recession fears and other folks in real estate, cutting costs and losing jobs. Nobody has lost their job here at JWB. And a big portion of that is because we build our income streams not just to depend on home sales, right? We build a significant amount of our income coming from property management services. So I hope you all are excited about that. That means that JWB has the strength to be here, not just today, but for multiple market cycles. And I think that's what you guys want in a long-term partner. So, $5,000, 5,000 homes was a big number for us.
Yeah. I mean, as a teammate, I think it's incredible. As a investor myself, to me, that means the more properties you have under management, the better deals you get for supplies, for maintenance, for all, like your purchasing power and your economies of scale of having somebody likely within 100 yards of my home that needs something, the moment that it needs something continues to go up. And I see it as risk aversion for myself as well. And getting a good deal. I like getting a good deal.
You like getting a good deal.
It's a good deal.
You get a good deal.
Yeah. Let's ask a question. I think this is an appropriate time to ask this question from Not Your Average Guest here in the Q&A. I've seen some recent posts on YEPP by JWB tenants indicating that they've had some issues with items in the home and they are not being repaired in a timely manner. Also complains about keeping their deposit when they did a good job of cleaning and extra fees. What are you doing to care for these tenants and change these negative reports?
I really appreciate this person sharing this feedback. The beauty of this type of a forum is that it's real and it's authentic. And so I like hearing some of the things that we necessarily have, some challenges on, or at least, a challenging review there. Property management is a hard business to make everybody happy. And our Yelp reviews, I'm aware of them. There are some negative Yelp reviews out there and, that's real. The challenge is that the vast majority of the reviews that are negative are not people that JWB Property Management has actually done business with. And that's what's really challenging.
Yeah.
We really hold our standards for who we put in your home. And many times that means denying people who otherwise would like to rent from us, but we can't. And it's because of a number of things that may come up on a background check, or the income might not be as verified as other people might think it is. And we just don't cut corners there. So if you actually go through some of the negative reviews that we do have, in addition to a lot of positive ones, but if you do read through those negative ones, you'll find that a lot of those folks are upset with an approval decision or haven't actually done business with JWB. In this case, it sounds like it is one of those folks who was upset that we, kept their security deposit. Again, this is a tough business to make everybody happy. And, our job is to perform for you as the owner. And, we make it very clear how the properties need to be taken care of and how you can get your deposit back upon leaving the home. And we spend a tremendous amount of time, setting those expectations up front. At the end of the day, if those expectations aren't met and we have to retain the security deposit to perform for you as an owner, we're going to do that on your behalf. And that's a difficult message. And so, I feel really confident that our team is making the right decisions. They are tough decisions, but that's why you hire us, right? And we're not going to be able to make everybody happy.
Yeah, I was just going to say, I'm glad I don't have to make those decisions, right? Like that's kind of the whole turnkey thing, right? Is outsource this thing. And I also, I would find it hard to believe that if you're doing this at scale, you'd get these types of like KPIs, like what we're talking about right now, right? Like total rented houses of 505 rented houses, an average initial lease of 26.9 months, 573 leases re-signed by April 2023. That's astronomical, and an eviction rate of 0.41%. That 573, that to me has to say I'm having a pretty good experience in my home, or a best-in-class experience at the very least.
There's a lot of volume that's going on here.
Yeah.
We're going to rent out, call it 1,500, 2,000 houses this year. That will be a new record for JWB, right? We're going to re-sign, call it 2,000 leases this year, so there is operating at scale creates consistency for you. It creates stability for you. It decreases risk for you. And I'm really proud that my team can hold such high standards, while doing so much volume, right? The 100 people that are working here at JWB are busting their tails for all of you. And I think that's what this slide represents.
I mean, that represents that to you as pride in your team. For me as a investor, I think of, man, if I'm getting this many leases, right? Like if you re-sign my lease, that means that my property is going to overperform. If my average lease that you sign is more than 2 years, like you're getting more than an average of a 2-year lease, that means my property is going to overperform. If you are this good at renting houses, it means that when I have vacancy, you're going to be able to get somebody in there. To me, these, as an investor, these are the most important metrics for me. This ability to keep a resident in a home, to find a new resident when it turns, and to, not have a selection process that really reduces the amount of evictions that happen, I think is how I think about it.
I like the way you think.
All right, buddy. So we're going to now talk about what the inventory looks like these days, right? What is the state of the economy? And then we're just going to give a couple of recommendations, and we have a couple of announcements at the end of this thing that I think are going to be cool.
And I'm happy to stay long. Pablo and I will be staying here. I know it's getting close to the 1 o'clock hour. For questions that you have, if you'd like to stay longer, we always set aside, call it 15, 30 minutes, as many questions that you guys have to be able to answer those. So I don't want anybody to feel like you're not going to have an opportunity to ask questions, but just go ahead and fire those in the Q&A.
Cool.
So this, investors really like to know what current inventory looks like from a pricing perspective, from a return on investment perspective. And so I just wanted to share that with you all here. We do have inventory available, and the inventory that we have, and many people aren't aware of this, but if you think about a year ago to where we are now, the inventory that we had a year ago was not fully rented at the time of purchase. The biggest difference between the inventory that we had a year ago and right now is that a significant portion of the homes that you're able to acquire right now already have residents in place producing cash flow day one. So really something to take advantage of there. Typical purchase prices are between about $220,000 to $290,000. To put that in perspective, the median home sales price in Jacksonville is somewhere around $350,000. So again, we're focusing on those workforce housing neighborhoods, and because that's where your best returns are going to be from all 5 profit centers. For your returns on an internal rate of return basis.
Yep, go ahead.
Sounds like you got something good you're cooking on right now. I'll just knock this out. So returns 12% for a return basis, and a little bit higher than that potentially. And then interest rates, big question mark for a lot of folks. Because of JWB's relationships, we're able to secure interest rates that are lower than what you're able to get out there in the space. So the typical client right now is able to earn a 5.5% interest rate for their loan. So again, there's a whole lot of noise about interest rates being in the 6s and 7s. And while that may be the case for many people out there, because you're a JWB client, you have an opportunity to lock up an interest rate, which is in the 5s.
So purchase price of 220 to 290, IRRs, right? This like internal rate of return of 12% based on all these data statistics. There's been multiple people that have asked, GC, remind me what the 5 profit centers are. You want to just kind of jam through that real quick?
Love that. So we've got net rental income, tax savings, principal pay down, home price appreciation, and inflation hedging and profiting.
Got it. And I saw somebody put in the chat here that I lost because the chat moves quickly, but can you just tell us what is your favorite profit center?
Well, I get to manage all these portfolios for all of you guys. And there's just one trend that I see over and over and over. When I look at how we are making all of you money, I look at it on a pie chart and I see which of these 5 profit centers is the biggest contributor to it. Without a doubt, it is home price appreciation over a long period of holds, right? So if you can subscribe to buying and holding for a full market cycle, your home price appreciation is actually going to be 60 to 80% of your total return on investment with a turnkey rental property with JWB, or however you invest elsewhere too, it will be the same. So here's the thing. Long term, that's how you are going to reach your financial goals. It's home price appreciation and these other profit centers. But the reason why I love rental properties is because you also get risk mitigation. You don't have to speculate to get that. The risk mitigation component comes from net rental income, the fact that it pays for itself every single month. So I can't choose a best. That's why I love all five. They work in cohesion. But home price appreciation will be the growth component that matters the most to you after you hold on for 10 or 20 years like I do or more. But cash flow, that net rental income, keeps you in the game so that you can get to a full market cycle.
That is what MVP Lee said that he would. So Victor, repeating the 5 profit centers are net rental income, so cash flow, home price appreciation, tax savings, principal pay down, and inflation hedging, right? And little teaser, there is a way to really, really learn this stuff that we're about to announce in a second here that we want to help everybody out with. But the belief is that the cash flow, as long as it is positive, then it creates this risk mitigated place for you to be here for a long time and gain the growth that you get from home price appreciation, which when we break down the portfolios over time on the show, we break them down in pie charts, and the pie charts look like a Pac-Man with their mouth open. And all the other profit centers are the mouth of the Pac-Man, and the Pac-Man itself is home price appreciation, which is why Gregg says that the wealth that you build over time comes from home price appreciation, and it's how the other profit centers play in to mitigate the risk during that time so that you can go through that period of wealth gaining and wealth creation. That is what we see over and over again on the show. So GC, so that is how you grow, right? Home price appreciation over time, but you also have, let's talk about the private lending overview as well.
Yeah. So wanted to shed a light on this as well. You know, JWB clients come to us for both the growth side, which is represented by the turnkey properties that we just talked about. So those who actually own the assets, which is many of you out there. And they also complement that with the income side. And the income side comes from our private lending investments. And so JWB has been borrowing money from you as clients since 2006. We've borrowed over $300 million, and we've paid every cent of that back with interest. That's over, 17 years now, right? So 100% success track record there. And we pay 10% interest as well. And this is that recurring income that comes for you. So if some of you are saying, hey, listen, I love the growth aspect of rental properties, but, maybe, the cash flows aren't as appealing, and all that. My answer to you would be, that's exactly right. Like the cash flows are not going to change your life on the rental income properties. You buy those for all 5 profit centers and hold on to them for a full market cycle. That's the beauty of that one. Income, that can come from private lending. That's that income plan. And so we have private lending opportunities available as well. For clients, you can reach out to your portfolio manager, and we have those opportunities available for you. And the same thing on the turnkey investment side. We have those homes that are available. If you're a current client, all roads lead back to your portfolio manager. They'll be able to set you up and make sure that we can add to your portfolio. And if you're not a client yet, you can go and, you can reach out to Madison here in the chat, let her know that you'd like to set up a call with us, or you can set up your own phone call with us by going to chatwithjwb.com, chatwithjwb.com.
Awesome. And we teased this a little while ago, but Gregg and I have been working real hard at this class that we're about to release on May 22nd, the Not Your Average Investor Guide to the Smart Way to Invest in Rental Properties. I think what we've realized is right now, more than ever, the market has kind of shifted in its understanding of the value of real estate, right? We're in this inflection point in the economy. So more than ever, it is really, really important that you are not just going along with the herd and doing things the way that, the average person does, because the average person during these like down cycles goes through a lot of pain, right? So it's really, really important for us to put out this way of understanding this thing from the data and the perspective that you need to make smart decisions as you were going along this journey. We're dropping this thing May 22nd. If you are an investor with JWB or a fan of the show, you're going to have an opportunity to take this thing for free for the first, like, I don't know, period of time, maybe 30 days, 60 days. We want some feedback on it. So stick around and we will release this. If you are part of this registration here, then you're going to get an email about it. But if you're listening on the podcast, make sure to reach out so that we get you the code to get in this thing for free. We've been working on it for, well, like
Months,
man.
months and months
It
and
was
months.
a lot of fun to film. It's been a lot of fun for my team to edit on the back end and put it together. It's entertaining, it's inspiring, it's educational, all the good things that you get from the show. And it's really just in under 2 hours, you're going to be very well equipped to handle this kind of like economy and be really well informed. So stay tuned for that. And again, GC, I think the main thing here is we're going to go into the Q&A. We got a series of questions here to answer for folks. We're going to stick around a little longer, but we know that this is the show that most of you attend, that you haven't attended, or that you just looked up Jacksonville rental property investing on Google, and this is the first show that comes up, right? It is the one that everybody downloads or watches on YouTube the most out of those things. If you want to stay informed and you don't want to just subscribe to the average media headline out there, you want perspective with your data from people that have been there before. We discussed in the past things such as the SVB bank failure and how it affects things. We'll get into like crypto. We'll get into like all these different subjects and the headlines of the day. And we give you the perspective that you need, along with educating you about what's going on in the market, what's happening in real estate that you need to understand on a weekly basis. So if you're listening on the podcast, subscribe to it, check in with us. It's a lot of fun. If you want to join us on a Tuesday or Thursday, be part of this community where people have made life-changing relationships, go to nyais.com. Join us live on a Tuesday or Thursday. We do it every week at 12:30 Eastern. And I think overall, GC, before we get into the Q&A, what's your overall advice, man? As you see this market, what is your prognosis here?
Well, I think these are challenging times to make smart and confident decisions as an investor. And think about being defensive at a time like this. Think about where you're putting your money and make sure that, you can protect that money, right? We certainly have challenges going on geopolitically that are outside of the US, and we have a lot of challenges internally in our country. And people have a hard time understanding how that's going to affect their assets. So just keep it simple, right? Be defensive, right? Focus on capital preservation, right? Turn equities into income. Income puts you in a position of strength, especially as you potentially are going into a recession. And focus on ways to beat inflation. Inflation is still really high. I know it's at 4.9% and it's not at 9% like it was, but it's still 2.5 times higher than what it should be. And it's hard for people to find assets that can earn over 5% without taking a lot of risk. So if you can do those three things, right? Capital preservation, right? Turning equities into income, and then beating inflation without taking additional risk, you're going to be making smart, wise decisions, and you can have confidence going into a recession. You do not have to be a victim of a recession, right? You can make smart, wise decisions. And a lot of those we talked about here today. Investing in real estate in a growing population like Jacksonville, a smart and wise decision.
Yeah. And, we have a show coming up which is my investment journey, how I've acquired 3 properties in the last year and a half. A lot of it was that thinking. A lot of it was this idea of preserving capital, turning equities into income, and beating inflation. And I've done some pretty unconventional things in order to get there, and no regrets, right? Like
Worked out famously.
I feel like it's really crushed for me. So we got a lot more of that coming up on the show. So stick around, subscribe to it, show up on Tuesdays and Thursdays if you want to be a part of it. I think we got so many questions that on Thursdays we do this property of the week, and it's very like Q&A driven. I think we're going to push a lot of these questions to the Thursday Q&A, but maybe just see for the next like 6 minutes or so, we can answer a couple of these. What do you think?
I'll do my best.
Cool.
Quick.
Dave Bingaman asks, any plans to expand property management to HOAs and condo projects, or just to single family homes?
No way we want to get into HOA property management. I can tell you that. No, I mean, we're sticking to our zone of excellence here, and we're just continuing to grow on that. So no big changes outside of what we typically do.
Cool. Victor Mudrick asks, if I have held a home for 10 plus years, should I sell and buy a new one anticipating a major repair soon if I hold it?
It's interesting. I was just talking to another longtime client who's owned properties for 11 years and the same type of question. What I shared with him is if you look at the benefits of investing and holding from all 5 profit centers, that's going to overcome the additional cost that may come with holding a home, as it may need a new roof or it may need some type of repair, right? Those costs may come down the pike for you. But if you think about it from the 5 profit centers, you're going to win, even if those things happen. What most people should be focusing on is making sure your reserves are built up to handle cash flow swings, right? If you own a home for 10 or 15 or 20 years, somewhere around there, right? At some point, it might need a new roof, right? Start preparing from a cash flow perspective now, so you are not forced to make an unwise decision just to meet a cash flow need. And we didn't have time to talk about it on today's call, but I think that what's going on in downtown Jacksonville is so significant, especially for those folks, our clients who have owned for over 10 years, like Vic, as the question of selling. If it's a return on investment question, we need to start talking about the impact of downtown Jacksonville and what effect that's going to have on rents and home prices in the neighborhoods that you own properties, which is all surrounding downtown. So that stuff we're going to be talking a lot about. I'm actually putting a study together of other downtowns like Nashville and seeing what their home prices and their rents in the surrounding neighborhoods that supported single family rental properties, what happened there, to show people how investing in those neighborhoods where we are putting you is the best thing you can do to earn an above average return on investment and kind of hitch your wagon to a growing and revitalizing downtown. So I think that's a bigger thing than any potential expenses that might be coming down the pike.
Man, that is something that we haven't even touched on this quarterly update. This idea that cities' downtowns only come online once in a life. It only happens once.
Yeah.
Once a downtown pops, real estate goes crazy around it for a while and then stabilizes, and it'll never go back down from a certain expectation that you had at a certain point, right? Like if you look at Nashville and what's happened there when their downtown flourished, or you look at Miami, what happened there when their downtown flourished, it's like people think about, man, I should have bought downtown. But that really isn't available to the average investor.
Right.
What is available to the average investor is the workforce housing around it before downtown becomes this incredible thing. And there just isn't a lot of cities that most cities either have a downtown that's working or are really, really far from having a downtown that becomes a thing. Jacksonville happens to be right in that sweet spot where everybody around it sees it. Shark money, big money from Miami, from these other places are starting to develop their initial projects without subsidies and all these different things that are happening in downtown. All the indicators are there. And the moment that everybody realizes it, then this big wealth creation moment happens and you're either in or you haven't gotten in and you missed it.
That's right. I don't feel like I've done a good enough job of connecting the dots for our clients and for our potential clients of the urgency that there really is to be buying a single family rental property right next to a downtown that is at this inflection point. And there's a lot of data to support that this is a monumental moment for downtown. I'll give you one right here. 7 years ago, we had $500 million in development going on downtown. Right now, we have $5 billion of development going on in downtown. I was just in Washington, D.C. not too long ago, a few months ago, and I was looking at their state of their downtown report, and they were clamoring over the fact they have $1 billion going on. Little old Jacksonville has $5 billion of development going on downtown. You just haven't seen it all yet, right? That money is in the ground. It hasn't exactly come out of the ground, but it's happening. So yeah, I think this is a big thing. In fact, if I'm starting to think about some of our shows coming up and over the next quarter, I think we're going to do a deeper dive on that because it's a big thing you guys got to know about.
That is a big thing, man. That's really interesting. All right, Steve Facchetti, thank you for helping me. I know that I butchered your last name in the past, so thank you for helping me in the chat. So Steve is asking, does a 1031 exchange need to be a 1-to-1 or can be cash from the sale be used to purchase 2 properties?
Steve, great question. So a 1031 you can sell 1 property and you can turn that into 2 properties. You can turn it into 5, 10. There is no limitation that it has to be 1-to-1.
All right. And let's do one more and we'll move the rest of these to the
I don't
third
know, man.
stage. Okay.
I
All right.
think,
Let's
I,
keep.
I think we can roll. I mean, everybody's still here. We got over 75 folks that are here.
You got
know
it.
what?
Just
Let's
because
lean
my
in.
tummy rumbles like a beast doesn't matter. All right. Robert Jones says, if a rental property has a large lot, do you ever help add an additional dwelling unit to the lot? Our 58th Street property with JWB has such a lot.
If it has a large lot, do you ever help add an additional dwelling unit to the lot? Our 58th Street property with JWB has such a lot. It's definitely not something normal. I don't know if it's something that we would be able to do with you on that, but I'm sure we can help you in some way, shape, or form. So, Robert, just reach out to your portfolio manager. Something that's unusual like this, we want to help in whatever way we can.
Got it. Thomas Vickers says, can I sell one of my properties I own to another JWB investor that is currently under JWB management and they can keep the JWB tenant?
I guess, Thomas, in theory, there's nothing preventing you from doing that. However, that just doesn't typically happen. I guess let's start with the ultimate goal that you're going for there, right? Are you looking to increase your return on investment? Are you looking to diversify into another property? Are you trying to diversify out of this asset class? I think so. To answer your question quickly, that's not normal. In theory, you can do that, I guess, if you were to arrange that. But it doesn't happen normally. But I think there's so many things that we should be asking questions about. And that's why I would encourage you to reach out to my team and just come with the problem that you have that you're trying to solve. And I bet my team can sit down with you and say, okay, well, this is one of a number of solutions that may be a better solution than the one you're thinking of.
Yeah. And I think just to be more clear on it, right? Like, Thomas, if you are going to sell your property, you likely want to sell to a retail buyer or somebody that is gonna pay you full price, while JWB investors are buying investment homes, right? So like switching it with another one isn't going to get you full price, which is why Gregg is saying,
That's exactly right.
What is the pain point there, right? So like whatever the pain point is underneath it, let's talk. I think you want to talk about that and figure out what is the way that you maximize your return if you're also trying to keep your resident in there because you have a relationship or you just want to be a good person or whatnot. You can probably do that and still get better money.
Yeah.
But you're able to sell and do whatever you want with your property.
And so for those who are thinking maybe about selling, reach out to our team because there's a balance there, right? If it's a home that has a resident occupying it, it's hard to sell it on the open market to somebody who wants to live in that home. But JWB, through our relationships, may have an opportunity to sell it while the resident's still in the home. Right. So whenever you have a question about sales, when the time to sell is for you, best thing to do is to let our team know early and often so we can come up with the ideal solution for you.
Jag has this comment here in the chat that I'd love to bring up to you since we're sticking around here, Gregg. She says there's a Texas turnkey provider who pushes the strategy of 1031ing every 5 years to build the portfolio and avoid maintenance costs. What do you think of that?
I think it's short-sighted. I don't think they fully understand the 5 profit centers. I don't think they've owned 300 rental properties for 17 years.
There you go. I love it. I've been pushing GC to be more direct about stuff.
How's that?
Agree with. Dude, high five. That was the test. You passed. A+. Pedro Nacianceno says, can we invite Mayor Curry for a follow-up? The last one was great. So Pedro is a regular here. I mentioned all these like sharps and investors and whatnot that come on the show. We also got the mayor a little while ago. What do you think, GC? You think we can get him back?
He's a good friend, and I would love to have him back on.
He said he had a good time.
Do we might have the future mayor on as well? Today is election day in Jacksonville for the next mayor.
Oh,
and so we might be able to. We have Daniel Davis, who
we've had on twice,
who has been on our show twice.
Yeah.
And so we might be able to have the future mayor, and of course Mayor Curry as well. He's a friend, and always welcome on the show. So we'll see what we can do.
Awesome. All right. Denny Davis says, Gregg and JWB team, congrats on 5,000 plus properties under management. What is the organization's new stretch goal as you look forward to the latter half of the 2020s? Great update.
Danny, that's awesome. Thank you so much, man. We haven't identified our next stretch goal as far as number of properties under management. I don't know, but I'll keep you posted.
All right. Thomas Vickers with some context. I love this. So Thomas, who had said that he was asking maybe he could rent it, maybe he could sell the property to another investor, says the reason why was I have $200K in equity. I would love to spread it into other properties. What do you say about that, GC?
You know what? So that's why when you saw my face and I was kind of like struggling, I'm like, I'm sure there's something that we can do to help you keep this great asset that you have and let it gain in value from 5 profit centers and be able to use the equity that you have in the home. We are able to work with clients all day, every day. Many people think in order to tap into that equity, they have to sell the asset, but you worked so hard to have a great asset. You can still tap into that equity and keep the asset. So, Thomas, I have about 1 million ideas in my head right now that I could help you out with. But what I would encourage you to do is set up a call with your portfolio manager, and we'll be able to share those ideas with you. And I think it'll be ultimately a better thing for you.
Sounds like Thomas is thinking directionally correctly, right? Like tap in your equity, turn your equity into income. I'm glad you're here so you didn't, do something that would harm your long-term kind of like go for it.
And I'm really glad we stayed all the way till the end, Pablo. What do you think, man?
I'm never eating again. Forget it. Not your average guest I was asking about the tenant reviews indicates these tenants indicated they have rented over several years.
Yeah. And I think that was before I kind of gave the secondary answer there. So the majority of the reviews that I look at all these reviews, they are not folks that have rented with us. But in this case, the one that he was sharing was somebody who did rent from us. And that's where my answer, as far as us having to give tough answers when it comes to returning security deposits. Listen, we don't want to keep security deposits, but I also don't want to come to you with large maintenance expenses when somebody broke something in your house. So, it's a tough thing to do to be able to act on your behalf. And that's what our charge is. And that's what we're going to continue to do.
Got it. Zach Correa has I think it's a statement here. Jacksonville is home to numerous Fortune 500 organizations and different businesses which give employment to the present and future. What is the availability of jobs forecasted over the next few years? As an investor, I would buy properties now to take advantage of that growth and rising housing need. More jobs in Jacksonville means more people would like to live in this city, and therefore they need good housing facilities.
Great question, Zach. I just wrote down, I'd love to get some data to support, rather than just my thoughts on this. I'd love to get some data to support this. So maybe we'll add this to the upcoming show mix, some data to support the jobs forecast. Man, there are so many good economic drivers here in Jacksonville, and they continue to grow. One of the biggest ones is fintech, right? We continue to add strong employers in the fintech space. And there's just so much positivity in that space from a couple of things. Number one, we have FIS, which is Fortune 500 company that is in the fintech space, and they're headquartered here. We have other employers.
Just built $100 million headquarters.
Yeah, just built that, solidified their presence here. We had their CEO on the show as well.
I remember
which was a great pleasure. Other employers, right? Dun & Bradstreet just recently moved to Jacksonville. Their headquarters is here. PaySafe just added 600 jobs to Jacksonville. So many good things. But the thing that I think is going to move the needle more than anything is the University of Florida is in talks right now, and the money has already been set aside. City Council approved it. The state has approved it, right? We're in the how we are going to do this phase for the University of Florida, bringing a graduate level campus for fintech and health tech that is going to be located most likely in downtown Jacksonville. And this is going to be one of the largest economic drivers for jobs and raising median incomes over the next market cycle. So I'm super excited to share more and more about that, but that is going to be a major, major influence.
Man, if you want to talk about just a home run for economic development, as you know, like I was super involved with economic development in Miami from like 2010 to 2018. And we made a lot of push to make it like Silicon Beach down there, right? Like we were trying to get tech companies down there. Consistently, the one thing that we could not overcome, we had people with money, we had people that wanted to live there. The one thing that we couldn't overcome was a world-class institution feeder system of talent,
right? Which
is the number one thing that these top-notch companies, venture-backed companies, all these different people look for if they're going to set up an ecosystem down there. The idea that a public Ivy League school, as Kelly called it in the past, obviously a great school, just a phenomenal
Harvard
school.
what?
The Harvard of the, anyways, University of Florida is a top 50 university. It is one of the top public education universities in the country. Highly, highly, highly competitive. They have the biggest AI supercomputer.
They do in the world.
in the world. And to think that two verticals such as fintech and healthcare tech, two things that you can be really confident are part of the future economic mix of the world are going to be, they're going to start a graduate program here that supplies that talent with world-class resources from a world-class institution like that. Man, I can't imagine a higher, a bigger, like grand slam home run for like economic development and job creation, man. Really cool.
Super excited about it. We've got a number of topics that you're going to hear more and more about over the next quarter. And that's one, hopefully we'll be bringing back to you.
Yeah. And just for the record, not Florida State, University of Florida. Much better.
Go
school.
Gators.
All right. David Dorsch has the last question here in Jax. By the way, Greg and I are both graduates of University of Florida. We can't.
There you go.
David Dorsch has a final question here. In Jax, what's the change in cap rates for both core and value add multifamily in the last 12 months or so? You got that?
Yeah. So he's talking about the fact that, so cap rates, if we're talking about multifamily, right, it's largely cap rate driven. And when interest rates go up so high from the Fed that you can't necessarily get a loan when you buy a multifamily property, it's going to decrease the demand for multifamily assets. And ultimately what that does is that increases your cap rate on future purchases. A lot there. Ultimately right now, cap rates have gone up for multifamily, right? The demand has gone down because interest rates on loans for those who would add multifamily are a lot higher than they were in the past. So multifamily is not nearly as strong as it was a year ago, largely because that's even more sensitive to interest rates than regular single family homes.
Okay, good answer, man. Really good question here from Dave Bingaman. Dave, thanks for contributing. This is a great observation. Why do you have so many already rented properties available to sell? Are you losing JWB investors, or are they just taking their profits and reinvesting in other JWB opportunities?
Love that question. It gives me an opportunity to clarify it a little bit better. JWB is a machine of building assets and renting them out, regardless of how many we sell or we don't sell. So like, for example, last year, we built about, I think it was in the low 300s for the number of homes we built. And this year it will be somewhere around 390 is what we will build. Well, we may not sell that many homes. We continue to build up our inventory and rent that out because that's who we are. We love these assets and we want to have a runway of assets for you as a client for you to be able to purchase. And so the fact that we are, let's see, what are the numbers? We're going to build 390.
I can go back to it.
Yeah, we're going to build 390 this year. I mean, we're selling 151 houses. That would be us selling more than the number of homes that we built. But so that would be kind of the opposite. But like in reality, that may not always be that way. They're two independent things. Did I say that clearly?
I was too busy looking for the data. Is this the data that you wanted to go back to?
Yeah. So we have 151 property sales that have happened this year. Mm-hmm. The new homes completed, we're at about 70. So that means we're on pace to build about 280 this year now. Like most businesses would look at that. Mm-hmm. That's not the same for us because we love owning this asset because it pays for itself, even if I don't sell it to you. So don't look at those numbers and say, oh, geez, that is success or not success. Like, for example, from 2011 to just recently, we were buying 2 to 3 times more houses than we were selling each year. And it's because we were acquiring all of this land so that in future years, we could build that out. But if you looked at that and you said, well, geez, you bought 900 houses one year, you only sold 300. Does that mean that you don't have enough demand or you don't have enough investors? No, that wasn't the case. We were stockpiling inventory in advance so that it could be used for turnkey inventory when demand is there for it. So our business model is a little bit different than another model, I would say.
Yeah. So to answer his questions directly, are you losing JWB investors or are they taking their profits and investing in other JWB opportunities? No.
JWB investors are not leaving.
Yeah.
They're staying.
Yeah, correct. So that's a no. And then why do you have so many already rented properties available to sell? It's because you have the unique ability and position to be able to build it, get it rented out. You can hold on to it as long as you want and you bring it to market already rented because that is what you do in your world-class asset.
I love it, right? We love it. And there's no, I mean, this is an asset that pays for itself. So there's no additional risk like you would have in other businesses of inventory risk. It's not the same for JWB.
Good stuff, GC. An hour and a half today, man.
Awesome.
Yeah. Listen, We love doing this. We love doing this show every Tuesday and Thursday. We love the community being a part of this thing. So we go long because we appreciate it and we hope that you get value out of it. And the fact that there's still 60 people an hour and a half in on a Tuesday, middle of your work week, taking time to be here is really, really fulfilling. So thank you so much for joining us. I hope that you stick around, join us on Thursday when we do the JWB Member of the Week. We'll answer more questions there. We'll get into it. Subscribe to the podcast. If you can, leave a review. It helps other people find the show. And it's been growing. The audience has been consistently growing, which tells us that you all are referring your friends. So really, really appreciate you doing that. I can't turn this thing off without asking Jen Filson's question because she's the godmother of the JWB Not Your Average Investor community. She asks, not sure if this question has already been discussed, but what about the new law in Florida preventing migrant undocumented workers from working in the state? Is this affecting JWB building timelines on new properties?
I'm unaware of that law, so I can tell you it's not affecting our timeline.
Okay, there you go. There you go. Thank you for being here. Thank you for letting me be a part of it. GC, I'll give you last words.
Just every time I get to do one of these quarterly calls with you all, it's just such a pleasure. I just appreciate the community we have and the platform that we have. And I just want to keep bringing everything I can to give you the data with the perspective to help you make wise choices. And so it's an honor to be here with all of you. I appreciate you guys making this a part of your day, and we'll catch you on the next show.
So whether you join us on Tuesdays and Thursdays live, like our community does here, in over 100 a week, whether you're listening on the podcast, whether you're watching on YouTube, we appreciate you. And the one thing that I ask is just don't be average. See you on the next one.